Hey, what's up everybody? It's A, and today we're diving deep into the world of investing, specifically tackling the age-old question, mutual funds or direct stocks. Which one is right for you? Both options have their pros and cons, and the best choice depends on your financial goals, risk tolerance, and time commitment. Not everyone wants to spend hours researching individual companies, and that's okay. That's why it's crucial to understand what you're getting into. We'll break down each option step by step, comparing and contrasting them so you can decide which investment strategy aligns best with your financial journey. By the end, you'll know whether mutual funds or direct stocks deserve a spot in your portfolio. Let's get started. Let's kick things off with mutual funds. These investment vehicles have become incredibly popular over the years. A mutual fund is essentially a basket of stocks, bonds, or other assets managed by a professional fund manager. Think of it like buying a slice of a massive pizza instead of the whole thing. This way, you get a piece of the action without having to buy the entire pie. Fund managers do the heavy lifting, researching companies, analyzing market trends, and making investment decisions on your behalf. Their primary goal is to generate returns by picking assets they believe will increase in value over time. One of the biggest advantages of mutual funds is instant diversification, which is crucial for managing risk. Instead of putting all your eggs in one basket, mutual funds spread your money across various assets, reducing potential risks. This reduces your overall risk because if one investment doesn't perform well, others can offset those losses, balancing your portfolio. Mutual funds are incredibly accessible, often with low minimum investment requirements, making them ideal for new investors. You can get started even if you're just beginning to invest, making it a great entry point into the world of investing. There are different types of mutual funds, like index funds, actively managed funds, and target date funds, each with its own strategy. Index funds track a specific market index, while actively managed funds aim to outperform the market through strategic choices. Target date funds adjust their asset allocation as you approach retirement, making them a convenient option for long-term planning. But keep in mind, mutual funds come with fees to cover management costs, which can impact your overall returns. These fees can vary, so it's important to consider them when choosing a mutual fund that fits your investment goals. Overall, mutual funds are great for investors seeking a hands-off approach, built-in diversification, and professional management. Now, let's move on to direct stocks, where you can take a more active role in your investments. We covered the basics of mutual funds, but let's dive deeper into why they might be perfect for your investment strategy. One word: diversification. Diversification is a key principle in investing, and mutual funds make it easy to achieve. If you put all your money into one company and it fails, you lose everything. This is a risk that many individual investors face. But with a mutual fund, your risk is spread out. Your investment is diversified across multiple companies and sectors. Even if one company in the fund tanks, others can pick up the slack. This balance helps to stabilize your investment. It's like having a safety net for your investments. This safety net can provide peace of mind, knowing that your money is not tied to the fate of a single entity. Professional fund managers bring a lot to the table, especially if you're not a financial expert. They have the expertise to make informed decisions. They're constantly researching companies and making investment decisions based on years of experience. This continuous monitoring can be invaluable. It's like having a personal financial advisor working for you, but more affordable. You get professional management without the high costs. Mutual funds are generally more accessible than buying individual stocks. They offer a way to invest without needing a large sum of money up front. Some brokerage accounts require a hefty minimum balance, but mutual funds often have lower minimum investments. This makes them more inclusive. This makes it easier for new investors to dip their toes into the market. It's a great way to start investing without a significant financial commitment. Once you've chosen your mutual funds, you don't have to constantly monitor them. This hands-off approach is ideal for busy individuals. Fund managers do the heavy lifting, rebalancing the portfolio and making adjustments as needed. They ensure your investments stay aligned with your goals. This frees up your time and mental energy. You can focus on other aspects of your life while your investments are managed professionally. With mutual funds, you get the benefit of automatic reinvestment. This feature helps to compound your returns over time. Dividends or capital gains are automatically reinvested, helping your money grow faster. This reinvestment can significantly boost your overall returns. Mutual funds offer a compelling combination of diversification, professional management, affordability, and convenience. They are a versatile investment option. They're fantastic for investors of all levels, especially those who prioritize a hands-off approach. Mutual funds can be a cornerstone of a well-rounded investment strategy. Now let's shift gears and talk about direct stocks. This is where things get more hands-on and engaging. When you invest in direct stocks, you're buying a small piece of ownership in a publicly traded company. You become a shareholder and can profit from the company's success. Unlike mutual funds, with direct stocks, you're calling the shots. You choose which companies to invest in based on your research and analysis. It's like being your own stock market guru. One of the biggest draws of direct stock investing is the potential for higher returns. When you invest in a company that performs well, your investment can skyrocket in value. Of course, higher potential returns come with higher risk. Another advantage is the level of control you have over your investments. You decide when to buy, sell, and how much to invest. This level of control can be empowering for active investors. You can tailor your portfolio to your specific interests and values. However, direct stock investing requires significant time, effort, and knowledge. You need to be comfortable researching companies and analyzing financial statements. Direct stocks can be more volatile than mutual funds, with prices fluctuating wildly in the short term. Direct stocks offer higher returns and greater control, but come with higher risk and require a hands-on approach. Let's delve deeper into direct stocks and why they might fit your investment journey. One enticing aspect is the potential for outsized returns. Investing in a company that performs well can grow your investment exponentially. Think about investing in Amazon or Apple in their early days. Of course, picking winning stocks is easier said than done. Another major advantage is the level of control you have. You're in the driver's seat making decisions and charting your course. This autonomy can be empowering for active investors. You can tailor your portfolio to your interests, values, and risk tolerance. Direct stocks typically involve lower expenses, such as trading commissions. This means more of your money is working for you. However, direct stock investing requires financial literacy, market knowledge, and risk tolerance. Stock prices can fluctuate significantly, and you might lose money in the short term. For those willing to learn, direct stock investing can be rewarding both financially and intellectually. It's a journey of discovery, learning, and potential financial growth. It's time for the ultimate showdown: mutual funds versus direct stocks. This is a debate that has intrigued investors for decades. Which one comes out on top? There's no one-size-fits-all answer. Each has its own set of advantages and disadvantages. The best choice depends on your circumstances, risk tolerance, and investment goals. It's essential to understand what you want to achieve. Generally, mutual funds are less risky due to their built-in diversification. They spread your investment across various assets. Direct stocks can be more volatile, especially if concentrated in a few companies. This can lead to higher highs and lower lows. Mutual funds offer diversification and professional management, but typically don't have the same explosive growth potential as individual stocks. They are managed by experts who make investment decisions on your behalf. Direct stocks, if chosen wisely, can generate higher returns, but come with higher risks. The potential for significant gains is balanced by the possibility of substantial losses. Mutual funds are the clear winner for those who prefer a hands-off approach. They require less time and effort to manage. Direct stocks require a more active role, with time dedicated to research and monitoring. You need to stay informed about market trends and company performance. Mutual funds come with fees that can eat into returns. These fees pay for the professional management and administrative costs. Direct stocks typically have lower fees but might incur trading commissions. These costs can add up, especially with frequent trading. If you're new to investing, have a lower risk tolerance, or prefer a hands-off approach, mutual funds are a great starting point. They offer a way to invest without needing extensive market knowledge. If you're more experienced, have a higher risk tolerance, and enjoy stock picking, direct stocks might be a good fit. They allow for more control over your investment choices. Remember to do your research, diversify your holdings, and be prepared for volatility. The market can be unpredictable, and it's crucial to be ready for ups and downs. The best approach is often a combination of both. This strategy can balance risk and reward. Start with mutual funds and allocate a portion of your portfolio to individual stocks as you gain experience. This way, you can gradually build your confidence and knowledge. There's no right or wrong answer. The key is to find what works best for you. Invest in a way that aligns with your financial goals, risk tolerance, and time commitment. Your investment strategy should reflect your personal situation. Do your research, weigh your options, and choose the path that's right for you. The ultimate decision is yours to make. So there you have it, folks, the lowdown on mutual funds versus direct stocks. The best investment strategy aligns with your financial goals, risk tolerance, and time commitment. Assess your risk appetite before jumping into anything. Are you comfortable with higher volatility for potentially higher returns, or do you prefer a conservative approach? Once you understand your risk profile, explore the investment options that suit your needs. If you found this video helpful, give it a thumbs up and subscribe for more personal finance tips. Hit the notification bell so you never miss an upload. Until next time, happy investing.